All right, welcome to the section on wave counting. I think as a good way to begin it, I would like to review an example of how not to count waves. So if you'll take a look at this particular chart, you might be interested to know that this is a reproduction of a chart that actually appeared in a stock market publication. Now, you have only listened to 2 hours of instruction on how to count waves. There's a lot more to come, and yet I have a feeling that some people in this audience could point out some errors in this labeling. Anybody see anything wrong with this chart?
Wave 3 shortest.
That's a good point. Wave 3 is the shortest. Wave 1 is longer. Wave 5 is longer than that. That's not allowed. Any other problems with it? Yeah. We've got overlap here. This wave 4 goes deeply into wave 2 territory. This is meant to be 5 waves labeled A, B, C, D, E. And D overlaps wave A. Those aren't allowed either. So we've broken some rules here, not just guidelines, but rules. Does anybody see another problem? Well, there is a place where there's a 3-wave problem. You notice this 4? You might say that came into the previous 4th, but how could it when wave 3 doesn't even have 5 waves in it? This Roman numeral 3 has 3 waves in it, up, down, up. And that's not right. So we've got the wrong number of waves in an impulse. It's supposed to be 5 waves, and we've only got 3. We've got overlap from wave 4 and 1, and we've got a 3rd wave, which is the shortest in several instances. You now know enough not to make a single one of those mistakes. So don't do it. Charts such as this, labeled elsewhere, are often a gold mine of instruction on how not to count waves. Very often I'll hear from somebody, yeah, well, so-and-so's opinion is this, and this guy says he's bullish while you're bearish. Well, there's plenty of room within the wave principle for diversity of opinion. You can have different, legitimate interpretations of the wave structure. But most of the trouble comes from people who are not following the rules, much less paying attention to any of the guidelines. They're letting their opinions come first, their gut feel come first, and their analysis come second, and you cannot do that. So don't do it, and you'll stay out of trouble. All right? Well, we've learned how not to do it. Let's take a look at how to do it. The charts that we're going to examine now are of the cocoa futures market. Now this, for the most part, is a reprint of a page from the Elliot Wave Theorist, which was published November 29th, 1982. I'm choosing this particular wave pattern and commodity for several reasons. First of all, this was done already in real time. The bear market that we're going to analyze was analyzed once before in real time, and the bottom within 4 trading days was recognized, and it was published as such. So we're not going to look back at a chart and say, oh, look how neatly it reflects Elliot now. You can see everything now. We saw it then, and we're going to show you how it was done. However, there's some other interesting aspects here. Do you know that the cocoa market is often described with the adjective exotic? It has nothing to do with dancers. It has to do with the fact that cocoa is considered a weirdly acting commodity. Some people think it just doesn't act like most other commodities. It's also hard to categorize. It's one of the foods, but it's not a grain, and so forth. So people consider it a bit unusual. A lot of Elliott Wave people might say, well, I'm going to stay away from this. One of the problems in dealing with commodity charts also is that you are not analyzing, most of the time, the price of the commodity. You're analyzing the price of a futures contract, which is a parasite on the commodity. And futures contracts have certain characteristics which make them a bit more volatile, such as incredible leverage. You're not out there buying 3 boatloads of cocoa with a broker. You are actually putting up a little bit of money and speculating on the trend and you are heavily leveraged. Therefore, many decisions are made not because you do or do not want to own cocoa. They are made because your back's against the wall and you're out of money in your account and you've got to get out of the trade. That tends to make the daily moves somewhat more volatile and perhaps cover more ground than they would if indeed people were truly trading the physical commodity back and forth. Also, you should know that the weekly charts, particularly, are what we call continuation charts, which means when one nearby contract expires, the people who keep the long-term data on the commodity futures merely tack on the next chart. Well, very often the next month's futures contract is trading at a different price. So you might see a jump in the price that essentially didn't really take place on the chart. That helps make difficult being certain that the waves you see actually happen because of real trading. And the last reason I chose this particular market to examine is that it is a market which is going down. It's a bear market. And rather than make it easy for us and pick a chart that we're visually comfortable with, a five-wave structure on the upside, I wanted to look very deeply at an ABC bear market decline, particularly the way wave C is subdivided. Well, let's first get a perspective on where the long-term wave structure was at the time. This is a monthly futures chart of cocoa. It begins in 1965 and goes all the way to 1982. Roughly speaking, it shows you a five-wave bull market. Again, we're dealing with futures contracts, and you probably notice, if you're very careful, that there was a slight overlap between 4 and 1. Well, again, in the price of the real commodity, I rather doubt that overlap occurred. Again, we have a little bit more in terms of stretching the prices in each direction because we're dealing with a leveraged futures contract. Roughly speaking, you can see that the five-wave pattern, the basic development is there. A first wave up, a second wave decline, which comes quite near the low and forms a base pattern for the really powerful move up in wave 3, a wave 4 decline, and the fifth wave to new highs. Remember that fifth waves in commodities tend to be the longest and most powerful of the three impulse waves, and this cocoa chart does show that, being a long-term bull market pattern. Now, one thing that's a bit unfortunate, in my opinion, is that commodity chart services issue charts on arithmetic scale. And it makes so much more sense to put them on semi-log scale, where you can see the percentage advances revealed, and usually channels that make more sense. In other words, the lines are more parallel. Unfortunately, long-term charts like this, which show bull markets on arithmetic scale, usually show apparently extreme movements in spike highs that are much more orderly on semi-log scale. Anyway, you can see that the five-wave pattern in all of its essential elements is there, and once the bull market is over, a bear market begins. Now, how many waves should the bear market unfold into? It shouldn't unfold into a 5 because corrections are never 5 waves. In this case, we're going to be looking for an ABC or 3-wave pattern. Ultimately, perhaps it will develop into one of the longer stretched out corrective patterns, which is a play on that 3-wave theme. But at the very least, we need 3 waves against the trend in order to say that the bear market is over or potentially over. Now, you also know from our discussion of guidelines where the bear market is likely to end. Somewhere in the span of the previous 4th wave. And that, of course, is in this area. And as I said earlier, the low usually occurs somewhere near the low of that preceding 4th wave. And, of course, that's somewhere in this area. So coming off of the high,